So today lecture is cost accounting. We'll start our discussion. There are certain type of accountings in the world. One accounting is called financial accounting. If you want to be an expert of financial accounting, CPA, Certified Public Accountant, is a qualification. In that we focus more about accounting standards as per US GAAP, that is generally accepted accounting principles. This kind of knowledge tell us how to record liabilities, asset, what is an asset, what is a depreciation, how to amortize, how to make financial statement, what are the formats. This is according to financial accounting. The other is management accounting. Management accounting is totally opposite. This is for management. So if management want to see the information in a specific way, we will make that way the reporting structure, because this is an accounting for management. There is no restriction, there is no standards, there is no hard and fast rules for it. So management accounting is for the internal management, and our focus is to show the operational expenses, income statement, balance sheet in a way as it can help management to take effective decisions. I will just give one example. Suppose as an accountant, when we pay rent, we don't think that this is a fixed cost, this is the variable cost, how to cover fixed cost, how to control variable cost. This is, as accountant, we don't do. But a management accountant or management accounting divides the expense into a meaningful behavior that is called cost behavior. It is fixed, it is variable. We use contribution margin concepts, which gives management an experience that this is variable means and this is the fixed. So how to cover the fixed cost, they can think a plan, and how to control the variable cost. So this is an extended version, that is management accounting. It is internal, it has no specific format, and this helps management to take effective decisions. And lastly, we have cost accounting, which is this plus this. Means we take the external formats that are standard, nice, beautiful, simplified, and we tailor them into according to the management needs. We do it that way. So cost accounting supports both financial and management accounting, and this is what we are going to discuss. We will see the external formats and internal decision making aids that we need for the company. When we see a product, any product, for this is a car for your example, but if it is a home, it's a tower, it's anything, it's a watch, it's anything in the world has three components. We can classify everything has a material, labor, and which is after these terms, everything is overhead. In accounting, we use word expenditures. Here we have our own terms. Overheads are being used for indirect expenses. What are direct, indirect? This is I will explain shortly. But if you see a calculator has material. Someone has assembled this, so labor. And without a shed, office, or engineers, or a mechanism, we cannot produce things. So we need overheads. Everything has overheads, material, and labor. We have some small calculations in our exam. He will say calculate prime cost, calculate conversion cost. So let's see the formulas. If we take the amount of direct material, we add with direct labor, it will be a prime cost. If we take labor and overheads, it will be a conversion cost. Conversion is a word from convert, means if I have milk, I will do something, I will make it as say chocolate, I cannot make a chocolate from a milk, but I can reinvent in a new shape, right? I will take the raw clothes and I will make the suits, this is conversion. Converting the shape of raw material into a new. I will take the timbers, the wood, that is my material, and I will apply labor and overheads. I will convert them into bedrooms, cupboards, sofas, any other things I can convert into. So that will be manufacturing and DL. Like you can see, material is not the part of the conversion, because conversion is convert, we are going to convert, so we need people and we need the place and the related expenses to it. Moving forward, we have non-manufacturing cost, which is related to the product. Everything is not manufacturing. See, if I want to make a pizza at my place, like what I need is material, labor and overheads. Overheads already I am incurring in my home. I have kitchen, I have stoves. But if I want to sell this pizza, I have non-manufacturing expenses. I want to save this pizza, I have administrative cost, I have selling and marketing cost. That will be a non-manufacturing cost. Every business, like Nestle is the biggest, largest producer, Procter & Gamble, they are producing items. They are always DM, DL and overheads. That is a cost. And plus, after once they manufacture, they need to store it in the warehouse. Then they have to advertise that this is our product, selling and marketing expenses. So that will be marketing, selling, administrative. These are also cost, but that will be a non-manufacturing cost, means it has nothing to do with manufacturing, but still it is important cost in our total cost sheets. Let's discuss some terms: product cost and period cost. What is a product cost? Anything that is prominent in a product that we can see, right? So material, labor and manufacturing overhead, direct manufacturing overhead, which we can observe. Period cost, okay, a lot of cost is not directly attributable to the product. For example, if you take if you open a restaurant and you paid the rent in 4 checks or 2 checks or 6 checks, whatever, for 1 year. In 1 year you will use the factory, right, or the restaurant place. Sometime it will be off, sometime long hours, weekend, too much sales. So you cannot say that this burger that you are selling per day rent is this much, right? Because some days no sales, some day too much sales, right? So we cannot directly say on the spot that this much rent you put it in overheads and this is the cost of the burger. So what we do is we wait for a period of time. Trade license we took, this is for 1 year, right? So 1 year we have no issue. We cannot say today I make a burger, I cannot say this is the portion of overhead, because I have to wait in 1 year how many burgers I made. Then if I divide with this cost, I will get the true per unit cost per trade license, right? These are period costs. Period cost is that you cannot assign to the product on the spot. I will give you another example. Suppose weather is good. Okay, we plan to go somewhere for a grill or barbecue or something. So now the first thing that we'll buy is the grill stuff, like there would be a griller. That will be an overhead, because this will not only use for this party, it will be used for different parties, right? This griller as a machine, But the chicken, mutton, beef, whatever we will buy, that will be only for this party. right? That will be a material. We can easily see that if there are 20 people going having this burger and parties or this grill, this chicken, mutton, we will consume. So easily we can see this is direct material. But this grilling machine will be used for several parties, right? So I cannot assign the full cost of this griller to this part, right? So same way we buy machines. Machine will produce every day a lot of things. So once we produce anything, we cannot assign these costs. So any such expenses will not be the part of direct cost, that will be indirect cost or a period cost that we have to wait for a certain period of time to allocate it to the other cost of productions. Okay, this is also very important. This will be used in next few discussions. In a manufacturing inventory, a manufacturing unit, we have three type of inventories. Suppose we go to Dubai Mall, we go to say any other mall, and we want to buy some cosmetics, for example. This is a finished good, it is ready to use. We'll just pay and buy. We need, say, clothing, it's ready, we'll pay. Some alteration is okay, but it will be ready to use. So in retail shop, things are ready. This is finished. In their factories, they will buy raw material. If someone is Nike, brand, someone make t-shirts, these t-shirts will be made out of raw material. So the manufacturing unit is going to buy the raw materials, right? Raw material and finished good. This is generally, we know that we have raw materials and we convert them into a finished good, right? So these are two type of inventories, the two shapes of inventories. And one more shape is called work in process. What is work in process? Suppose you were planning to make chicken madbi, for example. So what you did is you start grilling the chicken, and same way you start cooking the rice. I'm explaining you work in process, right? So I took the raw material as chicken, and I took raw material as rice. My main target is finished good, that is chicken madbi, right? I will grill this. I was cooking, I put marination, I put it on the griller, and same way I start my rice. Suddenly I receive a bell in my home, and 5 friends of mine, after 5 years, they came to my home. Now I have two choices. Either I will cook, or either I will say, okay, so they will sit idle, they will get angry. So I have to stop my cooking, right? Now this, what I have already cooked, is it's not eatable because it's not finished, and nor I can put it back in my raw material, right? Because it is already in process. So this kind of the shape of production process is work in process. Practically 31st of December, auditor will come in our office, in our manufacturing unit, and they will say, look, close the doors. Ask your guys to go, and because we have to count the stock, right? So that day people were working. Someone was fixing, if it is a furniture shop, they were fixing backs, someone fixing the arms, someone fixing legs. So you will see so many semi-finished chairs, right? This is semi-finished work, is work in process. They will count easily the raw material, and they will count easily the finished good, and that area, production floor, that will be a work in process, right? So in every manufacturing unit, we have three shapes of inventory. One is raw material, one is work in process. Some books we also called it as work in progress, process, progress, and the third is the finished goods. I will show you one table. It's some questions are based on that, so it is important. Before that, I will explain you the behavior of cost. Cost has a behavior, means pattern, Behavior is for the human beings generally. Cost also behaves sometimes, sometimes it becomes fixed, sometimes it's become variable, so it has a behavior. Cost behavior, variable and fixed. What is variable? Variable means, see, if I am more hungry, generally I am hungry, so I will eat more, If I am less hungry, I will eat less, right? Variable, as per my consumption, the cost will change, But some expenses nothing to do with usage. For example, my apartment, if I go, I don't go, I have to pay my rent, right, for 1 year, right? This is very common, that for expenses, fixed expenditure. If I make a company, this company, I run it, I don't run it. I have to pay my trade license cost, incorporation, other formalities. Later I run or not run, this is up to my own decision. So there are some expenses, overheads, which are fixed in nature. You utilize them or you don't utilize them, the cost will remain same. Rent is the best example for this. If you have an office, it's a rented office, it will open, it will not open, every agreed tenure, the rent check will be deposited, and they don't care you are using, you are making money or you are in loss. But there are some variable expenses, like employees, for example, if they are variable nature. For example, if you will work, you are a production guy, if your 1 hour is $10, so if you work 6 hours, you will get $60, right? If you work 12 hours, you will get more. So this is variable. If we invite 5 people in our home, we'll buy, for example, if they're not like me, then you will go and buy 3 kg. If you invite me, you will buy 5 kg, something 6 kgs. So variable, variable. As people will consume more, it will be this way. So as the name shows, variable cost is a cost that varies with production. Means if you want to produce more cost. If you want to produce less cost. Opposite, we have fixed cost. Fixed cost by definition does not change and has no link with output or production. You produce 1 unit or you produce 1 million unit, fixed cost, for example rent, will remain same. Okay, this is the behavior in total. Means total variable cost changes as activity level change. Total fixed costs remain the same even when the activity level changes. Right? This is fixed. Fixed costs remain same. Name shows fixed costs remain same. So same way fixed costs remain fixed under a situation, if you change the situation, relevant range, that is the acceptable boundaries, normalization, normal logics. In normally, generally, the fixed costs remain always fixed, right? But when you say relevant range, relevant range is a word that we use, that normal fixed costs remain fixed. If I will change the situation, then fixed costs may start behaving in another way, right? Okay, so this is variable cost and fixed cost. This is clear, right? Now I will build up more into, fixed cost per unit. First I will discuss fixed cost per unit. What is fixed cost per unit? Suppose this room, I will take this example, this room rent is, for example, 10,000 per day, right? And we are sitting, say 10 students inside, so per unit means 10,000 divided by 10. So per student rent of this room is 1,000, right? This is the concept of per unit. But if we increase the number of students, if we have 20 students, rent is the same, rent is 10,000. So per student now is 500. Means that as the number of units goes up, fixed cost per unit goes down, right? So that's why if you are a manufacturer, you desire to run your machines 24 hours because you already bought a crane, forklift, other machines. If they are idle, your fixed cost is not covering. But if they are going, if you have a rent-a car, you have a car, this car not going anywhere, so your fixed cost is not covering. You want to rent your cars for 24 hours, 1 month, 6 months, 2 years, so you can cover your fixed cost. So as a student, what we need to memorize is fixed cost remain fixed, but fixed cost per unit, as the production goes up, it start going down. So it start behaving like a variable cost, right? Because variable cost is that varies with the output. So he says fixed cost per unit goes down as the activity level goes up. Okay, what about variable cost per unit? Remain the same over a wide range of activity. How? I will give you an example. Variable cost. I want to buy material. Material is a variable cost, right? Okay, I go to the seller. I tell like I want 10 shirts. He will say, okay, yes, 2% discount, 5% discount. If I tell him I need 1,000 shirts, so he will be interested, because now I am a big customer, right? And if I tell him I need for next 2 years every month 10,000 shirts, so he will say, okay, he will leave his work, he will say, okay, come, let's sit and talk, because now I'm talking a serious business, right? So I will tell him, look, don't tell me different prices, give me a price next 2 years, same price. After 2 years, we'll see what is the new price. So what ideally I did, I fix one price with him. So my variable cost per unit remains the same over the wide ranges, right? This is how practically people move. Although variable cost material varies, sometimes we buy rice, it is $10, some $2, $9, someday $12. But when we buy in bulks and we plan our production, we can control our variable cost and it will start remaining same for a relevant range or a relevant period of time. So there are some questions related to this, that's why I give little emphasis on that. Now I'll give you 2 more terms. These are almost similar, direct and indirect. Direct cost is a cost that I can directly see in the product. For example, in this LED, we can see the screen. There are some other material, this is cable. So we can assume that someone has assembled it. So material and labor I can assume, right? And there might be some variable overhead directly like glue and other things, but I cannot see what is the salary of CEO of this company, accountant, secretary, rent, electricity bill. This is I cannot assume, but I can assume based on my experience if I work in this industry. This screen, for example, 1,000, some labor 200, I think to give them, they will fix it. This information is available, but how much the salaries, I give you example. So this cost can be easily and conveniently traced to a unit of product or any other cost object. The example are direct material or direct labor. Indirect cost that cannot be easily identified as a product cost, because the chair you are sitting in, so there is glue, there are screws which I cannot see because these are hidden in the chair. These are indirect material, right? indirect, I cannot see, but without that it was not possible to stand a chair. So there are always costs cannot be easily conveniently traced to a unit of product. That example is manufacturing overhead. So for easiness, cost means three components: material, labor and overhead. Two are direct always. Material and labor is direct and all other are indirect, right? Okay, I will move forward. Now we will study a lot of terms related to cost. There is no question in this chapter except few questions for prime cost and the conversion cost. Full and direct costing. Okay, I will give you one example. Suppose your car is not working. You call your friend and ask that, can I use your car? You said, yes, you are my friend. Okay, you take, but do one thing, that as much you drive, just put the fuel into. Means if you drive more, put more fuel. If you drive less, put less fuel, right? So what he or she is asking is a variable cost linked with the consumption. If you drive more, put more. If you drive less, so this is variable. But if your friend is like a business girl or a boy, so my car is from a bank and my per day rent is, say for example, 100. So give me 100 plus whatever you will use, do it. So you are asking for fixed cost plus variable cost, right? So if you add these fixed plus variable, it will become a total cost, right? So this is called full cost. Direct costing is directly, like DM, variable cost, when you take only a variable cost. So it says under GAAP, all manufacturing costs direct, labor, variable overhead and fixed overhead must be treated as product cost, and all selling administrative costs must be treated as period cost. The approach is called absorption costing. So we have two type of costing system. One is absorption and one is variable. In variable, we take everything that is variable as a part of the product cost, right? In absorption, we take all this as a product cost. So I will show you this diagram. Product cost, you can see this is absorption costing and this is variable costing. Everything in absorption like DM, DL and variable overhead and fixed overheads are part of absorption costing. But in variable costing, we have DM, variable, DM, DL, variable overhead, but there is no fixed we put as a part of product cost. So how we will get the questions? Calculate product cost by using absorption costing. Formula is DM, DL, variable overheads and fixed overheads, right? When the same question he says calculate product cost by using variable costing, take DM, DL and variable overhead, don't take the fixed part, right? So this is what is absorption and variable costing. This is a method to calculate the fixed cost. We will be given a total cost, we will see the variable cost, and then from this we can calculate the fixed cost. How we do this? The mechanism is pretty simple. We have some months. This is the data given to us, January, February, March, and these are the hour of maintenance and these are total cost for maintenance. Step number 1 is take the highest activity, and step number 2 is take the lowest activity. So we'll see that out of this data, the highest is 800 and the lowest is 500, right? So anytime he says calculate fixed cost by using high and low method, first step is given data, take the highest value, take the lowest value and take the difference, and you will see this is 300 and 2400. This is variation. If we take the highest and lowest, so we take the variation. Variation is variable, right? So if you divide this total cost divided by number of units, you will get variable cost per unit. Now you have a total cost, you have variable cost, right? So we can, fixed cost plus variable cost is total cost. If you have total cost, you have variable cost. By subtracting, you can get the fixed cost. So this is how he write this equation. Total fixed cost, he took anything, like you can take the highest and lowest, anything will give you the same answer. He took the highest 800 into variable cost and minus total cost, so you will get your total fixed cost, that is 3,400. This way it goes in a nice way. Got it? So this is a question. There are a couple of questions in our past papers. Calculate fixed cost by using high and low method. I will repeat. First step is take the highest value. Step 2 is take the lowest value. Then once you have a difference, divide them. Per unit variable cost will come. And then take either a highest value or a lowest value and fit in this equation. Missing figures, you will get the plus minus and your answer will come as a fixed cost. This is good. Now moving forward, there are so many terms, so we will go through. One is linear cost. What is linear? Linear is a mathematic term from a line, Some things, few things goes in the relation. For example, variable cost in the relation with output. Labor, So variable cost is a linear cost, but fixed cost is not a linear cost. It's a non-linear cost because fixed cost has no relation with the other things. It will remain fixed forever. So non-linear cost and fixed cost per unit is a non-linear cost. We have step fixed cost also. Step cost. What is step cost? Rent is the best example. Generally rent is freeze for 1 year, then 5% will increase, another year will freeze, right? So 1 year step, another year step, another years. So some costs behave in a step way that it goes upper and then it fixed for the next years, right? Tenancy contracts in Dubai is 5% every year you can raise. So, and in Sharjah 3 years you can have your fixed contract, then it will be a raise zone, right? This is the general law, I know. Moving forward, we have marginal cost. Marginal cost is additional cost. I will give you one example. Suppose we invite 100 guests and we call the chef, because 100 guests we cannot cook for them. We are human beings, so I will call the chef. Chef will come and he will cook. Right? So chef says, look, 100, 200, I don't care. I will come. I will charge you per hour. Right? So he came. I paid him, say for example, 1,000 for his service charges for 1 hour. What happened is that one of my guests, they have some guests from US and they were 10 in numbers, so they couldn't leave them at home. They bring it in the function and they ask me that these are my guests, can I bring them? In this way you cannot say no, so you have to accept 10 more, but the food is ready for 100 people. Now you have total 110 people, so you will call the chef again. Right? Chef will say, look, 10 people, 20 people, 2,000 people, I don't care. I will charge 1,000 and I will come. So you call him, So now 10 people per unit cost, how much? 1,000 divided by 10, right? That is 100 per person. Previously, 1,000 people or 100 people you invite and the cost was 1,000, so 10 per person, right? So this 10 that extra guest came, it is a marginal cost. It is above the normal cost. In sometime businesses we have get situations where we are not able to plan well. So this is an unplanned kind of production, that is additional cost. So marginal cost is a cost incurred by one unit increase in the activity level of a particular cost drivers. So if you are inviting 100 guests, you paid for, this is a planned cost and you will get per unit less. But anything unplanned, you will go for any future like usage, it will be always higher than the normal one, and that higher cost or cost of additional unit will be called as marginal cost. Marginal cost, incremental cost and additional cost, these are three names of the same product. In cost accounting, we have very typical scenarios like the calculations. Calculations are pretty much simple, that you will take your direct material, you will add direct labor, you will add manufacturing overheads. If you add these three, it will become your manufacturing cost. In manufacturing cost, if you add opening balance of work in progress and you subtract the carried down of work in progress, you will get cost of good manufactured. If you add beginning inventory of finished good in this and subtract the carried down of the finished good, you will get cost of goods sold, right? So this calculation has manufacturing cost, cost of good manufactured, and then cost of good sold. This is what he says, that for a single class of inventory, cost of goods sold is very easy. If they don't have work in progress, you can take inventory, add purchases, less in ending inventory, you will get the cost of goods sold. Here, beginning work in progress, total manufacturing cost, ending minus, you will get cost of goods manufactured. In this, if you add, as I told you, the finished good brought down and you will subtract the carried down of finished good, then you will get a cost of good sold. So a lot of small calculations are involved in this concept. Controllable and uncontrollable cost. Controllable cost means which is in the control of you as individual or a manager. For example, you can work with 3 accountants, so you can lay off the 4th one. But a few things are not in our control. For example, interest rate, economy, growth, stability, laws, taxes. So that will fall under the category of non-controllable cost. This will be used later when we'll study performance management. Your performance sheet will include only controllable cost. We cannot hold you responsible for uncontrollable factors. Avoidable cost is which you can avoid, right? If I ask you how much it costs you to come here for the class, you say first we go to McDonald's, we take the meal, then we do a little bit shopping, and then we came here for the class, right? So total expense is 2,000. So I can say that this shopping and McDonald's is avoidable. You tell me what is the right fuel cost to come here. That is avoidable cost. Committed cost, another name of fixed cost. Right? Another name of fixed cost. Incremental cost is the additional cost. As I told you, marginal, additional, and incremental. These are 3 names of the same thing. Differential cost. Differential word is from difference, means which is different in 2 decisions, right? Suppose you want to make a school, you want to make a hospital, so some cost is common, like rent, XYZ, but there are some cost which is not common, that is different here, right? So that will be a differential cost here. Engineering cost. Engineering cost is more into setup cost, that is, Nestle, Procter & Gamble, when they start building a plant, they have a layout that this will be machine 1, 2, 3, 4. This will be an engineered cost, cost of manufacturing, infrastructure, Discretionary, another name of controllable. Discretion word means that what is in your control. So discretionary and controllable is the same concept. Outlay or outflow, these are 2 words. Outflow means that you actually paid, like we bought a machine, we pay for it. This is outlay cost, right? Opportunity cost is the maximum benefit foregone by using a scarce resource for a given purpose. What is opportunity cost? Suppose you have money, you went to bank, they said invest with us, so we'll give you 3% interest, and you went to a stock exchange broker, he said 10%, right? So if you will invest with a bank, you will be in opportunity loss of 7%, because if you invest this money in stocks, you may get 10%. If you invest in stock 10% versus bank, you will be in opportunity gain of 7%, because you took a right decision for a right allocation, so you are getting a gain. This opportunity cost is when you have free time. Suppose you have 2 hours, you can take CMA class, you can sleep, you can watch movie, you can go outside, you can talk on phone. So whatever you choose will become the opportunity cost of the others, because resources are scarce. We cannot increase 24 hours a day. 24 hours will remain. Like if you are busy, you are free, I wish this 24-hour day should be 28 hours, so we can work 4 hours more, but this is not possible at all. So economic cost is a cost that is the sum of implicit and explicit. I will explain what is implicit and explicit. Explicit means which you can see, explicit, visible. That is invoice, receipt, payment. These are explicit cost. Implicit cost is like opportunity cost that we cannot see from the eyes, but still it is costing us, the cost. Imputed cost are those that could be involved in decision making even though no transaction has occurred. So that will be imputed as another name of implicit. Okay. Relevant costs are those future costs. See, when we acquire a business as a management, when you acquire a business, so very important for you to consider those costs in acquisition cost, which is relevant. Means we cannot put here and there cost. So as a cost accountant, we should know what is relevant, what is not relevant. That will be a concept of relevant cost. Means which is directly we can assign this. For example, as I use this McDonald's and shopping, that is not a relevant cost. That's why I will not put it in my cost sheet. So relevant cost is that is related to the concept of the business. Some cost that we did in the past and now it is finished, and there is no recognition for that. For example, if I am in an interview and I'm saying that I spend say $300,000 last 10 years on my education, and so I expect something out of that. So they will say, see, this is sunk cost. This is you did it on yourself. Now tell what is your salary expectation, right? So let's put it in a commercial example. You are a scientist and you invent a formula. For that, 10 years you spend, you remain in a lab, you test on cats, on dogs, and finally you come out with a formula. This is sellable to the medicine companies, right? So you as a scientist come to a medicine company and you said, in 10 years I spend $1 million, give it to me. They'll say, no, look, this is what you did is a sunk cost. You tell what you want for this formula. Like generally this industry goes on royalty, like how many tablets they will make, certain percent will go to the scientist, right? So sunk cost is a cost that we did in the past. Historical cost, all cost is a historical cost. Means the cost, purchase cost, it is categorized as historical cost. The assets are recorded at cost in accounting. This is the principle. Same is the way. We have joint cost. separable cost and byproducts. What is joint cost? Joint cost is a cost of common processes. For example, if I want a diesel, I want Supreme, I want super jet fuel for the aeroplanes, I need to first drill the earth, put a refinery, inject the oil, refine it till it reaches to the stage where I can allocate this is high end, low end. So this is all joint cost, common cost, right? Separable, one stage it will become separable, and byproduct is a product that is not our main product, but it arises from our main product. We are making this product like if you are making sugar from sugar cane. When you crush the sugar cane, the long ones, the waste will go here and the juice will go for making sugar. But the waste is the raw material for the paper industry. So we as sugar company, we don't care about this waste, but so for us it is a byproduct. We are not aiming to. We are all doing CMA. Our main product is recognition, designation, and high salaries, right? But byproduct is we will have some social networking, some gatherings, that we are not. We don't want to make friends to do CMA. We are doing CMA to get a designation and professional exposure, education. That is a main product. But once you become CMA, there will be some byproducts will come, so that will be technically called as by. In every business we have spoilage. For example, manufacturing I'm talking. See, some companies, they import big drums, they cut them, into and repack them into a gallon or liter or something. So when you cut a big drum, of course, some drops will fall here and there. In our home, when we bring a plastic pack of oil, you cut and you are putting in the pots, 4 or 5 floors, drops you will certainly throw on the floor, right? This is common. So why not technical persons? So this is how we have to see that what is a normal spoilage. Means 2%, 5%, 3%. If it exceeds that percent, then it will be a abnormal spoilage. Rework is a cost. Why? Because you did wrong work, so you have to do rework. And we will discuss performance management chapters that doing the work first time right is our objective. Means because if you have to do the rework, it will be costly, it will waste the time, it will waste the resource, right? So doing the work first time right is now the total quality management, right? So rework is because you did bad things, bad work, you have to do the work again. Scrap consists of raw material left over from the production. Like we were cutting something, cuttings are separable, and this is we can sell them, it has some value. And waste is the leftover and it has no monetary value, so we just have to waste them. Carrying cost is a cost of carrying the inventory. When we buy stocks, we have to shift in our warehouse. Warehouse should have electricity, heating, cooling, then it should have security, it should have accounting software, accountant, auditor, if you have more stock. This will be creating a cost called carrying cost. So we will study one system called just-in-time inventory management system later in some other discussions that will tell how to save your carrying cost. You as CMA, when you join your jobs, the first few things you have to check this way, how they are storing their stock, what is the carrying cost, this is the knowledge that we are acquiring. Transfer in cost, that is from, there are two terms, transfer in and transfer out. One department giving you cost within the company, transfer in. You are transferring some cost to another department, that is transferred out. Value adding is, we will discuss value. Value is a good concept. So we need to add value, means the perceived cost should be less and the perceived benefit of the item should be more. So how it brings cost, we'll see. In another unit of variance analysis, we'll see we can work on capacity, normal capacity. I'll give you one example. See, you want to do CMA, so maybe today you are thinking I will study 24 hours, but practically if you see we work 10 hours, 8 hours, so we go home till 2 hours left in the night, and if someone calls you, your good loved ones, so you cannot study even, so you have practically some hours to study, right? So theoretically 24 hours, that is a theoretical standard. Practically you have 5 hours in a week you can study. This is normal capacity. Is normally a student can study 10 hours, 7 hours in a week. That is a normal capacity. Same way in manufacturing units, if you are an owner of a shop or you run a laundry shop, you have machines. So you want to run your machine 24 hours because your fixed cost will cover as the machines will work. This is a theoretical. Practically you are running maybe 10 hours, 12 hours, and normally machines work 10 to 12 hours in a day. This we already discussed. Absorption, that is the composition of fixed and variable. Only variable is just take the variable cost. This is the repeated slide. I told you how to calculate product cost by absorption and how to do it. What is not product cost, that will be classified as a period cost. So anything not product cost will be automatically classified as product cost, period cost. So we have three type of costing. Actual costing means actual bills, actual entry. Normal costing means direct material actual, direct labor actual, but overhead will be budgeted. And extended normal costing means everything budgeted, means material budgeted figure, labor budgeted figure, overhead budgeted figure. This is later in budgeting portions we will see, because this is just an introduction level of chapter. We have target costing, means you are trying to achieve a target cost. You are saying I will produce in $2, this is your target. If you meet, then that is a target costing. That's the end of our discussion. We'll do a couple of questions quickly. These are past paper questions, so if you are more comfortable with this, means you can do the questions. I will read it for you. Which one of the following best describe direct labor, right? If you remember the slide, direct labor is common between prime cost and the conversion cost. So if you see prime cost include DL, yes, because DM and DL is your prime cost. Period cost also, period cost is the cost that is the overheads generally, right? So product cost is DM, DL. So both product cost and a prime cost, that is the right option. A and C, but because D is both into, so that is the most likely answer. Is saying what is inventorable cost, inventory, inventory, how we give inventory. First of all, when we manufacture something, it goes in inventory as an asset, right? When we sell, it becomes an expense, cost of goods sold. So he said that inventorable costs are regarded as an asset before the product are sold, because when it will be sold, then one effect cost of goods sold, the other effect is sales, right? Yeah, you should know the formula of conversion cost. If you did direct and indirect wrong, direct labor and direct material is prime cost, indirect labor and factory overhead is only overheads, of course. So C is okay. Conversion cost do not include, because conversion cost formula is DL plus overheads. Cost allocation, which is the next chapter. Costs are allocated in many ways for many reasons. Why we allocate cost in different departments is because we want to enhance the reporting so people can take effective decisions. So B is measuring income and asset for the external reporting, like how much finished good we have, how much raw material, how much is the income from that particular segments. Which one of the following is least likely, means it is not the part of the cost. So material, labor, overhead, but the commissions, sale commission. Sale is not cost, sale is different. So if you see D option, sale commission is not the part of cost accounting system, but product costing, efficiency, inventory valuation, this is the core part of the management accountancy, right? Cost accounting. Well, he's saying that give out of 4, which one is the example which can be direct and fixed. For example, we can hire an employee, we can tell them this is your basic salary which will remain fixed, plus if you do this kind of work, we will give you some incentive that will be variable. If sale will be done, we will give you the money, if not, then no. So only salary is something which can be fixed and variable, which is the right option here. But if you see water is fixed or variable? Variable, because as much you will use, your bill will come, right? Toilet tissues, if you use more, you will get more, otherwise you will come. I think we should rename this tissues. Advertising advertising same as variable if you add. So only salary is which is direct and fixed, means fixed and variable. It says M produces 200,000 unit of goods, DM is this much, labor is this much, and indirect labor, which is overheads, of course. So he's saying calculate prime cost and conversion cost. I have a question. What is the prime cost? Okay, so 2 million and 1 million, 3 million divided by 200,000. This is 2 million, 3 million. So you have 15 per unit. What is conversion cost? Direct labor and overhead. 1 million plus 600,000 divided by unit, so you will get a conversion. He's saying a cost incurred for benefit for more than one object, means common. More than one means for various work we are doing a cost, that is a common cost. Yeah, joint cost, common cost. If you see variable cost, conversion, prime, that's not the right option, so only this is the right option. See, he is saying that item would as good wood, screw or glue with indirect material, because glue cannot be seen. So indirect material is overheads, right? So that's why you took factory overhead. It's not a labor, it is indirect material. If it is given indirect, we will take indirect option.